Hi, I'm Fernando Torres, and I'm here to help you understand the US tax code. So, in my previous episode, I talked about US Code 26, Chapter 26, subsection 280A, business use of a home. And so, one of the first things that I went over was the first line, A, is an individual or an S corp. So my assumption why it says S corp, and so what that means is basically any shareholder of an S corp. And I believe why they put that is because a lot of S corp owners were home-based businesses, and so there was no particular line to write off the home use. So what they were probably were doing was they were probably using the Schedule C only for the home business use expense. So that usually kind of creates a red flag where you just have one expense, no income. So that probably was a workaround for for Congress to be able to deny that claim. Another area that I love, it doesn't say shareholder of a C corp. So that is a workaround right there. That's one that I don't have in my book, and so that's exclusively um, provided to you today on this episode. Is that if you have a C corp and it's home based, you could potentially write off that portion of your home on your Schedule C. So let's see what else that I can discuss. A lot of the rest of the subsection just discusses how the expenses are calculated, um, about the indirect and direct cost. Let's see. Um, there's a funny section that says any individual who uses the unit under an arrangement which enables a taxpayer to use some other unit, which basically is kind of bartering and exchanging. So if you have a friend who has another S corp and you want to trade, they're gonna disallow it. So that's a very funny section for me. Let's see. Of course, if you let somebody in the family use it, that's also going to disallow the home the the use of that room for business use. So it's like I said, you're going to prorate the prorate. So it could be an immediate family member, and so they discuss what an immediate family member is. Usually, it's a parent, maybe like a cousin, uncle, things like that. Let's see what else is kind of interesting. Oh, this one's pretty interesting. So it's kind of weird. I'm assuming this would be for a whole home. So if you have a partner that's not a family member, and they have some equity interest in the home, you can and they live there, you can actually expense 100% under the business use. So that was quite interesting. Let's see. And they discuss some of the guidelines under that method I just discussed. There's something about not-for-profits. I didn't really get into that because I don't really deal with it, but maybe I'll check it out later because people always want to know. They always have questions about not-for-profit. So I've been getting a lot of calls lately, and within the time frame that I've owned my company is people always want to know a little bit more about not-for-profits, and so that world is governed differently. And you do want to be more careful because you can lose your 501(c) or whatever status that you have if you don't follow the guidelines. But I think what I discussed about the workaround with the C Corp is big. If you want a partner to co-own a home and write it off for the business, I think that's another key workaround. I didn't detail that in the book. So that's what happens when you read the US code. Also in this one is the Augusta rule, which a lot of people, it's a trending topic on social media, especially TikTok, where everybody wants to portray their tax expertise, but they really don't know the US code. And that's why I created this series so that we can dive deep into it and I can bore you with this great stuff. All right. That concludes today's session, and I hope you have a good one. Bye.